Hello, in this presentation we will enter an adjusting entry for unearned revenue into our bookkeeping problem in Excel, keeping in mind how that same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We will first take a quick look at QuickBooks and then enter this data into Excel. Here we have a balance sheet report generated within QuickBooks, and what we're considering here is the accounts receivable account. And what is in the accounts receivable account will include amounts that we have received for which we have not done work yet. This is a bit unusual in terms of the way we're going to track things within QuickBooks. In other words, we received payment before we did the work, or in our case, before we delivered the guitar. We got a down payment on the guitar. The traditional way that we should record this in normal accounting would be, or generally accepted accounting principles would say that we would have to debit cash or increase the cash account and credit an account called unearned revenue. But if we do that, it's more difficult for us to track the customers because the customer tracking function is related to the accounts receivable account. So it's easier within QuickBooks. It makes sense to put that a negative asset into the receivable rather than recording a liability called unearned revenue. So to see that, we see that if we go to the detail report, we have this one client. If we go through the detail that has a negative receivable, that doesn't make sense. There's no such thing as a negative accounts receivable. That would mean that we owe someone else money and therefore not be an asset of a receivable, but a liability. In this case, that liability called unearned revenue. That's not exactly proper, but again, it helps us because once we have the invoice created, we can then match that up to this kind of subsidiary ledger very easily, and that's the reason for it. What we need to do, however, if we're going to issue the financial statements, is go through these accounts and see any of those negative receivables and adjust them so that they are not negative receivables, but are actual liabilities as of the date that we actually present the financial statements. That's going to be the adjustment that we will have now. Let's take a look at that in Excel. Here we are within Excel. We are in the Adjusting Entries tab, and we're going to be entering our adjusting entry on the left and posting that not to the general ledger, but to the adjustment column of our worksheet. The adjustment for unearned revenue is going to be a little bit different than we typically see in most accounting classes. So I want to point out what we first would see in like a textbook problem, and then explain why what we're working with here is a bit different as we go through this problem, which is related to what we might see in software such as QuickBooks. So if we go through this item, if we were to see a textbook problem, then we would see something that would have unearned revenue in it, and we would know that it was an adjusting entry. And if we go through our adjusting entry process, we would know that cash is not affected. It's going to have something in the balance sheet account above the line here related to unearned revenue, and that's going to be, of course, unearned revenue. So that account we know is going to be involved in this transaction. So I'm going to make that yellow. And then typically there's an income statement account also related to our term, in this case unearned revenue. And it's a little more tricky for most people to pick this up because we usually deal with expenses, but it's going to be the revenue account usually. And so it would be one of these three revenue accounts that we would be on the other side of this. Now I'm not going to highlight that because we're going to do something a bit different within this transaction. And that's because usually if we were recording this in a typical textbook fashion, when we had the unearned revenue, when we collected revenue, we would have, when we collected cash before earning the revenue, we would have increased the cash account, debiting cash. And then we would not have been able to credit the revenue account because we had not yet earned it, and therefore would be crediting the unearned revenue account, the liability account, representing the fact that we owe something in the future. That's the traditional way, that the way we should be recording the prepayment of something. That would happen if we had like a security deposit, in our case on a guitar. Someone gave us money before we gave them the guitar. You would think that we would debit the cash and credit unearned revenue because we haven't delivered the guitar yet and therefore have not earned it. Until we do, we owe something in the future. We owe the delivery of the guitar. Note, we don't have anything in unearned revenue, however, and therefore we're not really adjusting unearned revenue in order to see how much of that revenue has now been earned. What we're doing is a little bit different, and that's because of just the logistics of the software and tracking information. And that is that we've done something that's not exactly proper in generally accepted accounting principles, but which works if we incorporate it into our adjusting process system. And that is when we got the deposit in the guitar in this case, we did not put it, we debited cash, we increased cash, and we didn't credit unearned revenue, but instead put that information into a negative receivable. So we ended up with a negative receivable rather than a positive or an increasing unearned revenue. In order to see that, we can see the trial balance over here and look at our subsidiary ledger. So we're going to go to the trial balance tab, and we're in the subsidiary ledger, that's CR through CX, and we're looking at the accounts receivable subsidiary ledger. And we go through here, if we look at these ending balances and we see a balance that's negative, that would look funny. That would mean that the customer owes us. And if we go through these balances, we see this $300 for string music. So we have a credit and no related debit to it. That's unusual for an accounts receivable account. Usually we do the work before. That's what accounts receivable means. People owe us money and then they paid us, meaning we usually see a debit, in this case of $300 possibly, and then a credit to match that out, the debit showing the invoice that was created, the credit showing the related payment. In this case, all we have is a credit, and we've got this negative receivable. That doesn't make sense in terms of our accounts for accounts receivable. So what we need to do is go through here and pick these accounts out, and we're just going to make an adjustment for them as of the end of the time period so that our financial statements are correct. We're going to keep this. It makes sense logistically because then I can match up the invoice that will happen later, a later point in time, to that payment that has already happened and match it up in our subsidiary ledger nice and neatly. Whereas if we had simply recorded it to the undeposited funds, a lot more difficult to match that up. So it makes sense logistically to do this. However, it's not exactly right because we ended up with a negative receivable instead of a positive or an increase in the liability. So all we're going to do is adjust that. This is an accounts receivable account, and we have a negative receivable, so we're going to increase it by that. I've gone back to this tab, by the way. We're going back to the adjusting entries tab. And so the other side of this is going to be the accounts receivable account. And what we have here is a receivable that's going the wrong way. It brought the receivable down. We need to bring the receivable back up by that $300. So we're going to do the same thing to it as its normal balance. It's a debit. We're going to debit it. So we're going to copy the accounts receivable, scroll back down. We're going to start a new transaction, and it's all going to be as of 2/28, as all adjusting entries are. And we're going to put there in the debit side, right click and paste 1, 2, 3, the accounts receivable. It's going to be for that $300. And then we're going to credit something for that same $300. And of course, the credit then will go to the other account we've been talking about, which is unearned revenue. That's a liability account. It's going to go up with a credit, and therefore we will do the same thing to it, crediting it in order to increase it. And that will represent the fact that we have received a deposit in advance of us doing the work, in this case, delivering the guitar, and therefore have a liability. So we're going to copy this account. We'll put that on the bottom in B26 and right click, paste 1, 2, 3. Going to indent that now. Going to go to the Home tab, Alignment Group, and increase the indentation. We'll then post this out. This is the journal entry. This is an adjusting journal entry. We're going to post it, therefore, not to the general ledger, but to our worksheet here and see a quick example of what is happening. So we're going to go to accounts receivable first. That's our second account. So up here, here's accounts receivable. We're on the second, we are in cell M4. Something's in it. So what we're going to do is double click on it, go to the end of it, select plus, scroll down just a bit, and then click on that $300. Let's do that now. Scrolling back up, we are on M4, double clicking on it, going to the end of it, we're selecting plus, and then we're scrolling down just a bit, and we are selecting that $300 and enter. So there we have that. We have adjusted the accounts receivable for the 300, and now we're going to go down to unearned revenue. So we're in unearned revenue. We are in cell M17. We're just going to select equals in M17 and point to that $300. So we're in equals and we're pointing that 300, and that's going to increase the unearned revenue in the credit direction to $300. That will then put us back in balance. Note that there's no effect on net income from this transaction. All we did was move it from accounts receivable to unearned revenue, and no effect on income or expense accounts. Note, in a traditional textbook type question, the question would now be, here's the amount in unearned revenue. How much of that have we now earned? We would be asking the question of how much of the revenue that we had recorded in unearned revenue had now been earned. And at this point in time, if we saw that 300 and we said we earned a certain portion of it, we would say that we would have to decrease this with a debit and then increase the revenue for the amount that has been earned. In our case, we haven't yet earned it because we haven't delivered the guitar yet, and we're moving it from accounts receivable to unearned revenue.